In this video, we show how a balance sheet is actually built in practice. Accounting doesn't start with a balance sheet. It starts with transactions that happen in the business. For example, imagine the following events occurred during the year. The owner invested £50,000 cash into the business. This is recorded as equity. The company purchased equipment worth £10,000. The business made sales of £15,000 on credit, so customers still owe business money. This creates trade receivables. At the end of the period, we list all these balances in a trial balance. The trial balance simply lists all accounts with their debit and credit balances to confirm that total debits equal total credits. At this point, the bookkeeping is technically correct, but the accounts are not yet ready for financial statements because year-end adjustments are still required. Before preparing financial statements, year-end adjustments are made to ensure the accounts follow the accrual principle, recognizing revenue when earned and expenses when incurred. In our example, we have 3 adjustments. First, depreciation. The equipment purchased for £10,000 loses value as it is used, so we recognize £1,000 depreciation expense. The journal entry is debit depreciation expense and credit accumulated depreciation. This spreads the cost of the asset over its useful life. Second, accrued expenses. The company has expenses of £2,000 that have been incurred but not yet paid. To recognise this, we record debit expense and credit accruals. This creates a liability because the company owes money. Third, prepaid expenses. The company paid £3,000 in advance, but only £1,000 relates to the current accounting period. The remaining £2,000 relates to a future period and is recognised as a prepayment, which is an asset. The adjusting journal entry is credit cash £3,000, debit expense £1,000, and debit prepayment £2,000. This adjustment ensures that only the expense relating to the current period is recorded in the income statement. After recording the adjustment journals, we prepare an adjusted trial balance. This includes all updated balances. Now we see additional accounts such as accumulated depreciation, prepayment, accruals, and depreciation expense. The adjusted trial balance now reflects the true financial position of the company at year-end. Total debits still equal total credits, in this case £68,000. Once we have the adjusted trial balance, we can now prepare the financial statements. From the adjusted trial balance, we separate accounts into 2 groups: accounts used for the balance sheet, such as assets, liabilities, and equity, and accounts used for the income statement, such as revenue and expenses. Let's identify them. Assets include equipment, accumulated depreciation, trade receivables, bank and prepayment. This gives total assets of £63,000. Next, we identify liabilities. In our case, we have accruals. Total liabilities therefore equal £2,000. Finally, we determine equity. The owner invested £50,000 capital. During the period, the business generated profit. Revenue £15,000 minus expenses £4,000, so profit is £11,000. Profit increases equity and becomes retained earnings. Total equity equals £50,000 capital plus £11,000 retained earnings equals £61,000. And we can see that the accounting equation holds. Assets £63,000 minus liabilities £2,000 equals £61,000. Equity total is £61,000 as well. So what we've just seen is the full accounting process. First, business transactions occur. Then, those transactions are recorded in the journals. The journal entries are posted to the ledger accounts. A trial balance is prepared from the ledger balances. Adjustments are made to apply the accrual principle. An adjusted trial balance is prepared. Finally, the balance sheet is constructed from those balances. And that is how accountants build the statement of financial position step by step.